Hey guys, Max here, and this is your daily market update for yesterday, the 7th of January. We had some new employment data from the US come out, some inflation data from Europe, a few random stories, and then a quick update on the situation in Kazakhstan. So the markets, what happened? Well, following the albeit short trend of 2022, US stocks fell, and the S&P 500 is now set for its worst start to a year since 2016. Some of the mega caps, the trillion-dollar companies, fell and dragged the indexes down with them. The S&P 500, by and large though, didn't see a huge change, just a 0.16% fall in the day, while the Nasdaq saw a 1% drop, falling considerably further. The Dow Jones rose a little bit, sitting at a positive 0.3% for the day, as this rotation into value stocks and traditional companies seems to be pushing on forward. The MSCI World Index rose just 0.1%, with some of the losses in US tech made up for by the FTSE 100 and the emerging markets of the world. One thing that did actually buck the trend was a fall in the value of the dollar against pretty much every other currency, except of course the lira, no surprise there. Bond yields pushed forward further again, with 10-year treasuries up another 4 basis points. Oil was down almost a full percent, still hovering around that $80 mark though, and gold actually rose 0.4%, approaching $1,800 an ounce again. Crypto is still holding the lows it reached recently, Bitcoin sitting at about $42,000, Ethereum sitting at $3,200, and the rest of the market is of course in a similar position. No large gains or losses since yesterday, but of course just a week or so ago we were saying the same thing about Bitcoin at $48,000. So why is tech still falling? Why are bonds still rising? Well, of course, it's more of the same. More fears from the market that the tide is changing, monetary policy is changing, and that will, of course, impact asset prices, some negatively, some positively, and we're starting to see that play out right now. I did see someone ask why rising bond yields meant that tech stocks will fall as well, so I thought I'd just very quickly explain that, and it's actually really simple, to be honest. Rising bond yields means that capital is more expensive. Think of it as a company releasing bonds to the open market in order to raise funds to grow their business. With higher bond yields, that capital costs more money, so we see basically the same effect on valuations that we get from higher interest rates. It's more expensive to grow a business, which means for every dollar spent, you should expect less growth, and because of that, investors are expecting less growth, so they're selling out of their positions that used to make sense. Back when they thought that capital was going to be cheap forever, companies like DocuSign and Zillow had the ability to grow forever, but that isn't the case anymore. Of course though, this is now old news. This happened a few days ago where this tide changed, and we've been talking about this over the last couple of days, as it was all triggered by the Fed's release of the minutes, or basically the transcript, of their FOMC, the Federal Open Market Committee meeting back in December, where we learned a lot and we got a lot of insights into their thoughts, and it turns out that the Fed is actually more hawkish than the market thought. Now, the bond markets had for a long time just ignored all of the inflation data, and there was a lot of talk of the bond markets being smarter than the rest of the market, and to quote Cathie Wood, the bond market was sniffing out lower inflation and even deflation that was on its way in the future. Now, this idea was not as ridiculous as it sounds right now for a long time, and I had a fair few heated discussions with people telling me that I'm 100% wrong about inflation over the last few months for that exact reason. Now, the problem was I wasn't 100% sure why the bond markets weren't reacting to the high inflation figures either. So when people asked what my theory was, I literally said, I don't know what's going on, but your theory doesn't make any sense to me, and I think it's wrong as well. Anyway, we're now past that point, and we do now think we know what was going on. And the bond markets weren't sniffing out lower inflation in the future. They were sniffing out a Federal Reserve and an administration that actually didn't care about inflation and that wouldn't raise interest rates when it became necessary. This is what the bond market was predicting, not less inflation, just lower interest rates. Now, this idea is pretty much dead now. We've read the Fed statements and we've heard what was said behind closed doors, and these two theories, Cathie Wood's one and the bond market's one, are now both pretty much guaranteed to be wrong. Now, there is, however, new news regarding the macroeconomic situation in America, and that news has caused some new worries, and that's part of the reason why stocks have fallen again. So we got a bunch of data out of the US regarding employment, wages, labor force participation rate, and all stuff like that, and that's causing some volatility in the markets as well. What is the data we got? Well, to start off, the unemployment rate fell to 3.9%, which is obviously a good thing, on the surface at least. Job creation was 199,000 for the last month, which is an improvement, and again is good on the surface at least. We did, however, see that the labour force participation rate was unchanged. It did not get any better, and that is not good news, to be honest, and goes completely against the other metrics that the rest of the media is choosing to focus on. Average hourly wages rose 0.6% last month, bringing the year-over-year increase to 4.7%, which again is good on the surface, but take a deeper look and it really isn't. We also got some data regarding consumer debt levels, and in short, they're going up. It's getting higher. People are taking out more debt. This includes things like credit card debt and car loans and student loans as well, and in a high interest environment, this is bad news. So that is the basics of it. Those are the figures themselves. And the response from the media and the markets has been that these numbers are good, and that because they are good, the Fed is more likely to tighten their monetary policy sooner, harsher, reduce their balance sheets, and raise interest rates more. And that's bad for markets, which is why they had another little nervy yesterday. Now, my problem with this narrative is that the data isn't as good as it seems, and the Fed tightening their monetary policy, while absolutely necessary and long overdue, I want to make that clear, is going to impact the market severely. Now, first of all, the unemployment rate is under 3.9%, under 4%, which sounds great, but this is a manipulated figure, just like the CPI data we get out as well. If someone is fired from their job and they have a few $1,000s, so they just decide to take a couple months off from working, they aren't considered unemployed under that figure. Young people who live at home, maybe are 20, 21 years old, live with their parents and have no intention of getting a job, well, they're not considered unemployed either. This figure really is only useful for determining how tight a labour market is, and under this pretense, a low unemployment figure isn't always a good thing. With that figure at 3.9%, that means it's very hard to hire people, very hard to get good workers, and this forces wages up. And I know, again, that sounds good at first. Higher wages are great, but if they aren't as a result of increased productivity, then in the long run, they will just cause more inflation. We end up with a wage price spiral where the two rise with each other and actually cause each other to rise themselves, and inflation spirals out of control. Now, the other problem with wage inflation is that it's what we call sticky. Now, the best example of unsticky inflation is something like used cars. They may have risen a lot in prices over the last year, but when supply catches back up with demand, they will fall back down in price. Wages, on the other hand, don't fall so easily because people don't like to take wage cuts, so this inflation is basically here to stay, and there's no chance of it being transitory and being replaced with deflation in the future. Now, on top of that, wage inflation is still 2% lower than CPI inflation, which is 3% lower than real inflation anyway, so people still aren't better off in any real terms. Now, because of all this, that 3.9% unemployment rate isn't actually so great because it represents a very tight labour market as opposed to a country where everyone is working. Now, next we have the labour force participation rate, which is, in my opinion, the most important figure we have here today because it looks at every person in the economy and how many of them are producing, working, and generating wealth and the like. Now, of course, this number is never going to be as high as 90% because we have retirees, we have full-time students, we have people unable to work due to disability and things like that. But the change of this number is always going to be important because it represents how many people are working and whether that number is getting larger or smaller. The fact that this number did not increase last month is not good news because it means no more people are actually working despite the fact that the unemployment rate is going down. This is that manipulation of the data at work here. That means less wealth creation, less productivity, and a weaker economy. Now, this is just mostly being ignored though because the 3.9% is the headline figure. If you read an article about this data from a pretty standard media outlet, one that doesn't focus on business or finance news, you probably won't hear about this at all. You'll just see 3.9% good news. Now, job creation is at about 200,000 jobs last month. And again, that sounds great, but there aren't any more people in the country actually working as the participation rate is stagnant. On top of that, a couple months ago, the Fed were predicting that every single month would see 500,000 new jobs created every month, 500,000 new people working every month. But we haven't hit that number in a while now. We've been hovering around 200,000, so we are far below where we ought to be. Now, in short, the Fed especially is pushing this idea that the data is really good, and so it's okay that they turn hawkish. Now, full disclosure here, I am glad that the Fed is turning hawkish. It's the right thing to do, but that doesn't mean we should ignore the data that tells us the economy is not as strong as they'd like us to believe. We should all be fully aware that the labour market is very tight, and a big part of that is because people have left the workforce. Of course, though, the US isn't the only place that had some new data. We also got information from Europe regarding inflation, and if you're a regular viewer of this channel, you will have been expecting high inflation. We've spoken about the European Central Bank's hubris and their refusal to admit that inflation is a problem and is their fault, and they're insistent on keeping a dovish monetary policy, beaten only by Japan, which is obviously going to stimulate inflation further. Imagine my surprise then when the inflation data comes out and this was Bloomberg's headline. Euro area inflation unexpectedly hits record. What on earth are they talking about? I really don't know. And how have they been so blind as to not expect this? The guy who wrote that article, I had a quick look, he's been writing about the ECB, the European Central Bank, and inflation in Europe for months now, and yet he's still surprised at this development. This is just utter tripe. The level of journalism on Bloomberg can be absolutely atrocious at times. It's practically gaslighting in another form. I don't know what his agenda is, but if he doesn't have one, then he's just a crap analyst and should worry about his job, so there is probably something going on behind the scenes. Anyway, what does the data actually say? Well, inflation spiked really high, above 5% now, and this was higher than analysts were expecting. It's an all-time high for the euro area because it's not that old, and the ECB and Lagarde, the most useless woman in Europe, they're under a lot of pressure to reassure everyone that they aren't asleep behind the wheel. To be perfectly honest though, it's starting to look like they're drunk behind the wheel, not just asleep, and if they maintain this stance much longer, then they must be high as well. Now that is all the new data for the day, but we've got a few other things to look at briefly, starting with vaccine mandates and the push forward in the US for them. Now Citigroup is moving forward and is going to fire all of their employees who have yet to get the vaccine. Of course, we were told for 18 months that it would never get to this, but now this news doesn't really surprise anyone. It's been inevitable for a while now, but that does not mean it's legal or moral either. The Supreme Court is thinking about this in regards to Biden's workplace vaccine rule, and there's some doubt it'll be allowed at all. Of course, we have to wait and see, but whichever way this ends up going, I can say for a fact that it will not end right away. There will be legal battles, people suing their employers and their employers suing them, lobbying fights, and businesses who just ignore the rules and do whatever they want anyway and acknowledge that they'll pay the price later. This is obviously not going to end anytime soon. The situation in Kazakhstan is not getting much better. I've seen a bunch of footage of citizens in the streets handing out weapons, mass protests, and even some footage of what appeared to be a Kazakh army unit marching with protesters, apparently against the government. But this isn't at all confirmed, so I don't know if this is actually happening, but it could be going on. We do know that more people have died. The official death toll is 26 dead civilians, or as the Kazakh government is calling them, terrorists and armed criminals, and 18 dead security forces. The real death toll, at least on the side of civilians, is of course probably a fair bit larger than that, and of course not all of those killed were armed, as is evidenced by some of the footage coming out from there. Now, Russian troops are in the country. They helped to retake control of the airport in the capital Almaty, and I think 2,500 Russians are due to arrive all in all. This has, of course, got a lot of criticism from Western countries, but nothing has really come of it at all. This is probably very nice for Putin. He's been trying to expand or at least maintain Russia's sphere of influence, which includes Kazakhstan, and this gives him the perfect opportunity to increase his ties with the Kazakh government and maintain that influence. Now, at the very least, fewer people seem to be talking about Ukraine right now, as it seems our attention has been moved over. Will this result in a full-on uprising or something like it? Honestly, I still doubt that, but the possibility of some elements of the army being on the side of the protesters means that it's not at all impossible. The success of an uprising in that sense will basically be dependent on which elements and how much of the security forces change over, and then how much support Russia gives the Kazakh government as well. Of course, it is Saturday now, and markets have now closed for the week, which means that oil has now risen in price for 3 consecutive weeks. The Kazakh news has obviously helped this week, as it's been a pretty large producer of oil. Nothing crazy, but significant nonetheless, and this unrest has increased the likelihood of problems with production over there. To be perfectly honest, this is probably just more fear than anything physically concrete, as the amount of oil coming out of Kazakhstan into the rest of the world in places like North America is really rather small. Now, in other news, Richard Branson is considering setting up a SPAC in Europe for his Virgin Group. He's of course done this before with companies like Virgin Galactic, but to be honest, if he were going to do this, he should have done it a year ago when SPACs were actually doing okay. They've had an awful performance over recent months, and the Fed's turn is likely only going to make that worse. Now this is a few days late, but we didn't have time the last few days to cover it. But of course, Rivian dropped 20% in value after Amazon announced it would be buying some electric vehicles from Stellantis. This surprised people who thought that Amazon would only buy electric vehicles from Rivian for whatever crazy reason they came up with, and so the share price cratered. Now the EV space is obviously crazy. We all know that. You don't need me to tell you that. We've seen Tesla over the last 2 years, but there's something even more crazy about the EV space from unproven companies who are valued on magic pixie dust. That is pretty much it for the day. I'll see you all again tomorrow. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up. You don't have to buy anything. You don't have to hand over any card information. So if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like the USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.